All right, here we go. The daily scan for February 21st. It's Friday. The week is over. Thank God, although it may continue next week. So we had nothing but a sea of red today. There were some stocks that went up, actually, but mostly everything looked red. We're going to take a look at it and see what happened and see if that might continue. I think it probably will. As I've said before, when I talked about max pain and options expiration, it usually goes into the first day or two of the following week. So I expect that will probably happen again. I'm going to look at the max pain report and compare some of the stocks that we saw on it last week. But let's take a look at what happened today. So first, of course, I am still yet not a financial advisor. And I do not make recommendations to buy or sell. This is for educational purposes only. So you need to make your own investing decisions. Let's take a look at the market. And first off, if we look at the home page, you can see the market bias actually dropped significantly today. So that is a character change, especially if it gets below this low right here, kind of right in the middle of this range at this point. But I'll show you some of the charts. They're not all really have gone down enough to trigger bear signals. One more day and they will. So this could actually have a much steeper decline if this selling continues into Monday. I'll show you what I mean by that in a minute. You can see our stop lights up here is showing a caution signal. So the short term is bearish, medium term and long term are still bullish, but we have a caution. We have an orange light today. So first, let's look at some of the charts. The S&P, as you'll see, dropped dramatically. Huge down day, pretty much wiped out 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. Pretty much 11, almost 12 days. So that's more than 2 weeks worth of bullishness were wiped out in one day. And that's what happens when markets start to decline. They drop much faster than they go up. So that's why it's important to keep your eye on things and watch what's happening. Now, even though this closed today below the 21-day, which is what caused the short-term signal, the 5-day hasn't crossed yet, and certainly the 21-day hasn't crossed the 50. So this could be just beginning. In other words, some people I think will probably think that it's time to buy the dip and are convinced that the market will just continue to go higher. But I expect to see a 10% decline this year at some point. Not saying it's going to be now, but I think at some point this year and probably even over the summer, I think we may see a 10% decline. I think the market probably will end higher overall for the year. So I'm not saying we're going to have a huge crash, but I think a 10% decline would actually be healthy for the market to do that. It'll be painful for those that are holding, but it is healthy because the market's gone up so much. All right, let's take a look at the Dow is the one that dropped the most. United Healthcare contributed to that decline. You can see it had already started. In fact, it gave the signals way back here that it was starting to go down. And there's the squeeze down here. This is a daily chart. So we had a squeeze and the squeeze fired to the downside. Like I said, you don't know which way the squeeze is going to go. The squeeze here looked like it was probably going to the upside, and that's what happened. But this squeeze, all the momentum indicators was pushing lower and went below zero. So that one fired to the downside. And that means it's probably going to have another week or so. One thing that John Carter typically says is when a squeeze fires or when he gets a bearish signal, he usually stays in for 8 to 10 bars. So if we look at this one right here, let's see what that would mean. So that would have hit right there, right at the top of all the channels. So 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 10 bars right there at the bottom. And then when this squeeze fired to the upside right here, let's count those. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. hitting the upper Keltner channel, that's where he would have been out in this case. Now, yes, it did go up slightly a little bit next 3 days, but that was pretty much the high right there, especially intraday. So 8 to 10 bars and he's out. That's on a daily chart. So 8 to 10 bars on a weekly chart would be 8 to 10 weeks if you're looking at weeklies. I may look at some weeklies because I said I would look at weeklies on Friday, but there's lots of other things to look at first today. So I'm not sure if we'll get to it. We shall see. All right. How about Bitcoin? Do we dare? Bitcoin also went down today, but not too bad. I mean, there's not really hasn't created a lot of damage to the chart. The momentum is moving higher right here. It's in a squeeze. Squeeze appears like it wants to fire to the upside, but that doesn't mean it will. So, and you can see this. You can see this squeeze down here. It's when the Bollinger Bands go inside of the Keltner channel. So that's where it turns this bright green color right here, right through here. That's what makes a squeeze. This basically is how to create a squeeze without using John Carter's indicator. That's what it is, essentially, right there. So right now we are sitting right in the channel. It may fire to the downside, but it's sitting basically right on support, a little bit above it. Sorry, I took a sip of coffee. Even though it's 5:45, I'm still drinking coffee. All right, let's take a look at some other things. Let me show you, let's look at the 10-year. 10-year, I think, went down today also. Yeah, 10-year went down quite a bit. So I had shown before where it was a potential head and shoulders, left shoulder, head, right shoulder. I'll show you that in the market bias chart to show you where the target for that would be. So let's go over and look at that, and I'll show you what I mean. Even though we did get a bearish signal on the Dow, we didn't get it on the other ones, the major indexes up here. But watch what they look like. There's the S&P. Broke through the 5-day, the 21-day, landed right above, just barely above, actually hit the 50-day, and then closed slightly above it, and broke through this uptrend line right here. Now the line in the sand is 58.50, so we still have a ways to go. We're not even halfway there actually yet. Still have quite a ways to go to get to 58.50. That's the line in the sand where this could turn really ugly. However, it may just come down a little bit more Monday, maybe Tuesday, and then turn around and try to go back up again. So we'll see. But the bearish signal will happen when the pink line crosses the blue line. The 5 crosses the 21. If we get another down day on Monday, that will happen. So that means that right here, this will be red up here too. That'll give a bearish signal. But look at the rest of them. There's the NASDAQ composite. There's the Dow, which did cross over, short-term signal. There's the NASDAQ 100, getting there. S&P 100. There's mid caps. It actually did give a medium-term down signal today. Small caps already had given signals. New York Composite, maybe Monday. This one here already had signals. This is the Russell 2000. So everything looks just really ugly right now. That's growth. Growth is looking bad. Even value is looking bad. Dow Jones Transportation is heading down. Utilities, by the way, this one will give a short-term down signal too. It doesn't have it already. Let's look. Transportation, yeah, it already has one. Already has a short-term down signal. So everything just looks pretty bad today. There's now we're into the sectors. There's technology. Terrible day. What actually closed below the 50? That's not a good sign. Communication services heading lower. There's discretionary. Those are the 3 aggressive sectors, all looking terrible. However, look at staples, one of the defensive sectors. There's the rotation out of those aggressive and into defensive. There's utilities. Utilities didn't get hurt too bad today, if at all. Didn't really even go down. So there's the rotation. Here's healthcare. Healthcare hung in there. Energy pulled back a little bit. Materials pulled back a lot. So this is where gold is. We'll look at gold in a minute. Industrials was huge. Industrials actually gave a short-term down signal today. So it was a big down. And then financials went down as well. So everything looks like it's heading lower. Let's look at gold, see what that looks like. Gold actually hung in there. Gold didn't do too bad. Actually didn't really go down at all. Gold miners did though. So gold miners is leading things down. Silver was weaker than gold, and there's silver miners. Looks like gold miners also went down quite a bit. Steel went down. So everything's going down. They're not giving bearish signals yet, but if this continues next week, we're going to get a lot more bearish signals on the market bias matrix. And you can see right now, everything up here, the percentages are still green. But if they go below 60, that's where it turns yellow. And if they go below 40, that's where it turns red up at the top. So right now you can see we've got two red ones. We've got a yellow and a green, short-term, medium-term, long-term, and the overall trend is decidedly lower. All right, let's look at a couple of other things. Since it is Friday today and I've updated all the charts for the week, let's go to the charts page and first look at the index charts and look at our handy dandy monthly chart that I have talked about before. This is something that I saw John Carter showed it when he presented at the Money Show back in November. And he showed back in 2021, just before the 2022 bear market, these 2 months, this was November and December, and the market was hitting new highs during that period. Momentum was going down. So if it's dark blue, that means momentum is lower than it was the month before. So that's what happened just before the 2022 bear market. I have made comments before, and for those of you that watch One Rental at a Time with Michael Zuber, if you don't know that channel, I would highly recommend you go over and check it out. I know a lot of people on my channel came from there, but I've talked with him. I usually have a call with him on Sundays, and I mentioned that I think 2025 might look similar to 2022, which was a cyclical bear market. So there's the 2 months in a row. We had 2 months in a row already, December and January. February was actually, up until today, February was higher. February was light blue, meaning it was higher than last month. Today it's not. Today it's dark blue, and if we get more selling next week, it will continue to go lower like this one over here did. So we'll keep an eye on that. This is for subscribers. This can be found right on my website. These are the indexes. These are monthly charts. So this is what you want to watch to see if we're getting ready. I mean, you can see how high up, how overbought the whole market is right now. It's sitting right up here above its 2x Keltner channel. It's in the 3x area, and the monthly bars are declining. So momentum is waning, even though the price is going higher, except for gold. Gold looks great. Gold continues to go higher. This is a monthly, so we've got another week left for February. Bitcoin is hanging in there at the top, but it's just kind of going sideways. And the Russell, of course, has already come down more than the rest of them have. Definitely underperforming. Also, you can look at on that same charts page, you can look at the monthly charts for the aggressive sectors. That's what they look like right there, and defensive sectors as well. One other thing that I added last week, let's go back to the charts page. I think it was on the charts page. Well, one thing, I show you all the sectors together. This was just updated today too. So on the left are the aggressive sectors, and you can see what they look like. Just, get a sense for the overall direction. These are all aggressive. This is communication services, discretionary, and technology is down here. It's financials and industrials. Over here are the defensive sectors. So it looks very different. This is the rotation. Rotation is rotating into defensive, and that means Wall Street is setting up and getting ready for perhaps a longer bearish cycle. On the homepage, these are the equal weighted charts. This was updated today as well. You can always see the date in the upper left. So this is, I showed this yesterday. These are equal weighted. So the S&P equal weighted was underperforming the NASDAQ 100 equal weighted. Today, they both dropped, but NASDAQ actually dropped more. And you can see the momentum is starting to roll over right here. This might be at the early stages of this. So I think we may continue into Monday, maybe Tuesday. There always will be a reaction rally. Be careful with reaction rallies because it does not mean that we're going back to new highs necessarily. It could just mean that shorts are covering and making some money, and then the trend will continue. We'll have to see. I'll continue to update everybody and tell you what I'm seeing when I look at these, but just have to be careful going into next week. All right, let's see. What else do we want to look at? Let's go to the charts page again. And first we'll look at the Santa rally and the January barometer. You can see we had one negative Santa rally. The other two were positive. That usually means higher for the year, but it does not mean straight up. And here's today's candle after yesterday. Yesterday was a big selling day and it pulled back at the end of the day. Today, that did not happen. So when I talked about this yesterday, I said, you know, it looks like it's pulling back up, but don't be fooled. I think it's going to continue down. And today, not only did it continue down, but it ended right near the lows. So it basically ended because the market closed. Sitting right on the 50-day moving average. If it drops below that, then we're probably going to have, probably will come back down to the beginning of the year, which is this line right down here. All right, something else that I updated today on the market bias page for those that are subscribers. May not scroll down far enough to see this, but these are the top 20 large cap gainers and losers and small and mid cap gainers and losers year to date. This gets updated once a week. So you can see by the date right here, it was updated today. And it's an interesting list because you can kind of see what happened during the week. SMCI, number one of all the large cap of the S&P 500 and the NASDAQ 100, SMCI was number one. Look what's number one in the losers. Trade Desk. Trade Desk had a terrible week. Deckers, which had been a really good one, had a terrible week. Here's Constellation Brands, even though Warren Buffett announced that he was buying Constellation Brands. It was in the bottom 20. Tesla is in the bottom 20 this week. Datadog is down there. So all those are the losers. The winners over here, we've got Palantir, of course, CVS, Uber did really well. Tapestry did pretty well. Apple Oven did well, although it moved down. It was near the top of the list. Intel had a great day. Not a great day, but a great week. It actually has been pulling back the last few days. Starbucks is on the top 20 list. So it's interesting to take a look at what's on there. GE is number 20. You can also look at the small and mid caps down here. HIMS, number one. Out of all of the small and mid caps, HIMS is the number one stock. And the losers over here, Ironwood, Owens and Minor. So ELF, which had been doing really well the last couple of years, but it's doing terrible this year. So this is just a way to get a sense for, there's Abercrombie and Fitch, which had been just on a tear last year. And now it's in the bottom 20 of the list. So just an interesting list to take a look at. It gets updated every week, usually on Friday, and I did update it today. If we look at the portfolios page, for those that follow the long-term trend, I'm going to show this just very briefly, but this gives you an explanation of how this whole thing works. We got a go to cash signal for the short term, but not for the long term. So if we look at the chart, the weekly chart, it still is in an uptrend, and it's been in that trend ever since November 3rd of 23. So almost, it's about a year and a quarter. So you definitely would have got into long-term capital gains by following the strategy. And the whole strategy is explained right there on the website. But the long term still has not signaled anything yet. And it won't until it gets down below that line right there. And then it will give a good cash signal like it did right there. Now, in this case, we were in cash. Here's the primary trend flipped over way back here in March of 23. So that's where the primary trend first executed. And then we had a little go to cash signal right there. It was not a bearish signal. It was just a go to cash. And then for 1, 2, 3, 4, 5, 6 weeks, we were in cash. And then this brought us back in. And that's where we are right now. That's November 3rd, basically, was the Friday of that signal. So right now, the result is 40. It's a 40% performance in a year and a quarter. And if you were using the leveraged ETFs, which are down here, either for the S&P, the NASDAQ, or the Russell 2000, then 2x, you would have had an 80% gain. And using the 3x, you would have had 120% gain in a year and a quarter. So it's a pretty good signal. Next week, I'm going to update these. I don't know what the status of these look like yet, but these are the dividend stocks that I put on here at the beginning of the year. You can see what their performance was at the end of January. These are the dividend aristocrats. These are dividend champions. There's 15 in this group. There are 15 in this group. And then Vanguard high yield stocks. These are all the same. So there's 18 in this group. And this was the one that performed the best. 7.5% in 1 month. We'll see. I seriously doubt that we'll get better performance in February. February typically is not a good month in the second half. So here's what February typically looks like. You are here. That's today, Friday, options expiration day. We've got 1 week left for the month, and you can see what typically happens the end of the month for February. The dotted lines are post-election, which is where we are right now. So it looks like a continued downtrend into next week. The other thing that's interesting historically, and this all comes from Stock Traders Almanac, by the way, which you can go to stocktradersalmanac.com if you want to see more information or subscribe. The second half of Q1 is usually the worst half of the quarter. So it just started this week. Basically, the beginning of this week is when that second half of the quarter began. And usually the second half of the quarter is typically the worst part. So not only we may continue down next week, but that may continue all the way through March with reaction rallies, of course. So just keep that in mind. That's just historically. That does not mean that it will happen. Just means that historically, that's typically what has happened. So interesting. Let's go to the charts page again and look at the 10-minute charts, because those were pretty interesting today also. So here's the aggressive sectors. This is this vertical blue line is Tuesday's open. So we only had 4 days this week. This is where we opened on Tuesday, went sideways, went up, and then last 2 days came down. Tried to make a recovery yesterday. Today didn't. Continued down and actually started to roll over at the end. So I think that'll continue into Monday. Technology underperforming, financials under. These are all the aggressive sectors. Discretionary under, communication services flat, industrials under. And then if we look at the defensive, this tells the story basically. Healthcare definitely outperforming for the week. Staples outperforming, energy outperforming, utilities outperforming. So these are all the defensive sectors up here, and they are all outperforming. So that clearly sends a signal of what's going on. Let's take a look at the market carpet. This is very ugly. This is just today. So the size of the box is the market cap of the companies, and that shows you what happened just today. Looks like a lot of red. This is the sea of red that I talked about. Put it on the splash screen. Sea of red today. You can see, you just take a look at what, Nvidia down 4%, Google down 2%. Lilly kind of hung in there, didn't go down too much. We can look at this over 5 days, and it looks better over 5 days. And it should, because like I showed you on that 10-minute chart, it really started yesterday. So if we look at 2 day, now it's beginning to start to turn a lot more red. And then, of course, 1 day, and it is clearly a sea of red. So that's what the market carpet looks like. Let's look at the relative rotation. And this is for today. You can see just this is staples, utilities, real estate. All three are in the leading quadrant. Technology is up there too, though. So it's at least it's in the leading quadrant. It looks like it's starting to decline. Energy is trying to make it back up, but industrials and discretionary, especially, clearly lagging. Here's healthcare right there. There's materials, here's financials, and here is communication services. So again, this shows rotation into the leading sectors. The ones that are in the upper right-hand quadrant are all defensive sectors. So Wall Street, I think, is preparing for something. You can actually, let me see if I can do this. There is a way to, there you go. Just pull this backwards. You can see everything moving. So this goes back to end of November right there. So just the last 3 months, basically. You can see what it looks like. And right here, this is December 13th, middle of December. The only three that were in the leading quadrant are the aggressive sectors. That was the middle of December. Everything looked really aggressive, looked like the market would never go down. You can actually see this is the S&P up here, this gray area. And right after that is when it started to decline. And you can see what happened with the aggressive sectors. Two of them are now moving into weakening. And now technology is too. And instead, the defensive sectors are coming up to replace them into the improving quadrant. And as the market continues to go down, you see more of that happening. There's center. And then as we keep moving across, now the market is improving now, but you can see technology, communication services, and discretionary, the three aggressive sectors, are in the lagging quadrant, even though the market is beginning to come up. Now those should move into the leading quadrant if the market recovers. And they're trying to. And then they finally do move up there, except for technology was continuing to go sideways. And just take a look at technology. There's the U-turn right there, February 7th, February 10th. So there's the U-turn where it started moving higher, and technology then moved into the leading quadrant, which is where it is now, but it's starting to roll over. So we'll keep an eye on this, but it is clearly the rotation is into defensive and out of aggressive. I showed that on the sustainability ratios yesterday. Those actually got worse today, clearly. So here's the market. It was hitting all-time highs right there. Of course, not today, but 2 days ago, it hit all-time highs. But discretionary underperforming staples, the NASDAQ underperforming the S&P, technology underperforming the S&P, growth underperforming value, and the Russell 2000 mid-cap and small caps underperforming the NASDAQ. So this is rotation. This is Wall Street getting out of the aggressive areas, moving into safer areas. Typically, those will still go down if the market continues to decline or degrade, but they usually don't go down as much because the rotation is into those sectors. It's out of these sectors. So typically that's what happened in 2021, just before the long bear market. So be careful, be cautious out there. I just wanted to point this out to everyone. make sure that you're seeing these kind of things. Keltner charts. Yeah, so it's in the bottom section, but it's still within the 1x. It's still at the mean, basically, roughly at the mean, the S&P. When it gets down here to 3x down here, that's usually where the reversals come. So that's what we want to watch for. If the selling continues and it gets down here like this, that's the time to get back in. Not right now. This could bounce back and then continue to go lower. You want to wait for it to get down there before getting back in. Weekly trend. I want to see what that looks like today. This is one that I'd showed. I said I was waiting to see what happened with the medium-term trend. Still has not crossed over like it did in 21 right there. Still has not yet happened. And you can see in 21 on that day, this is actually a weekly chart. So on that week, we had a red bar and it went below the 21 week moving average. We did not get either of those today. So we didn't get a red bar and we didn't go below the 21. So this is still hanging in there, but it's getting weaker. So we'll keep an eye on that. This could be one more clue. And again, if it breaks below 58.50 right there, then all bets are off. We're probably heading much lower. All right. Sorry for the bad news. If you continue to watch this channel, and especially if you subscribe to the website, you'll be able to see a lot of these things ahead of time. You'll be able to understand what's going on in the internals of the market, things that most retail investors or traders don't see. Those are the kinds of things that are on this website. So there's a lot here, but it's kind of like a toolbox. You don't use everything all at once. You just kind of explore around, see what the type of things, type of charts that you like, and then watch things to see what happens. These are all of the industry groups right here. So you can see, and I just updated this today too. So this is for the week. You can see the ones that outperformed the most were in the staples sector. And the ones that underperformed the most were in the discretionary sector over here. Even gambling was in the bottom 10 this week. So DraftKings did really well last week and is still number 2, but it lost almost 8% today. And let's see what it did for the week. 1 week, DraftKings lost 15% for the week. Just out of curiosity, I want to take a look at that and see what the chart looks like. Yeah, so after a really great run higher, they reported on the 13th, probably right here. Now, in 3 days, it gave back all of that gain. It has now closed the gap. It is sitting right on the 21-day, which actually, under most circumstances, that's the point where I'd say this might be a good place to take a position if you missed it before. And right there is where support is, also right at the 21-day. So this is the area where it could bounce. However, number one, it had higher than average volume today. The momentum is rolling over. So if this crosses and this goes below 0, then that's going to confirm the downtrend is continuing. So we need to watch those things. But this right here is an area where I always like for it to pull back to the 21. That's an area to watch to maybe get back in. If it drops through that, if the market continues going down, then the next one is right down here, the 50-day. 50-day is 41.50 roughly. So if you're looking for an entry point for this, and in fact, I'll draw another support line right here. So just above the 50-day. So somewhere in this range right here, if you're looking to make an entry on DraftKings, or if you're already in it and looking to add more, then right through here might be the time to do it. But it's selling off along with everything else. So that's one way to look at different sectors by using the website. Just see which ones are performing or underperforming, outperforming or underperforming. You can see, let's see, soft drinks is outperforming if I click on the box. Obviously, Celsius Holdings had a great day today, up 27% just for the day. So that's one that had been selling off dramatically. That's one that at the end of the year, I said might be a good one to buy into just before everybody at the end of the year was just selling so that they can take their tax loss harvesting. And then usually these kind of names actually bounce into the new year. So right here was the end of the year. It had a little bit of a rally and then it continued to sell off. Now it's got a black candle. It needs to get above the 200 day, of course, but it's starting to take off now. So if we look at this on a longer term, you can see how far down it's come. This one was a great stock at one time. There's a double top right there. So this is where all these people that got burned want to get out, breaking even, and they did. And then it just continued to go down. It started to bounce, and people thought that was it. That was the end, but it wasn't. Went down, tried to bounce again. In this case, hit the 21 day, got rejected. This case, it hit the 50 day, 21, 50, broke through the 50, but wasn't enough. Rejected at the 50 again, rejected at the 21, and now today broke through. So it's finally broken through all of this overhead resistance except for this one right here. And I suspect that there probably were lots of shorts in this who probably shorted somewhere in this area right here. So they probably shorted down here too. And they probably shorted here as well. But these shorts are not going to feel pain until it gets above their entry price. So everyone that shorted in this area through here, actually all the way back up into here, they were feeling pain today. So they were covering. To cover, they have to buy. If it gets above 35, then there will be more shorts right here that will likely cover and probably will push it up to the 200 day up here, where it will have trouble getting through that. So the 200 day is at about 40 bucks. So that's Celsius. And again, I found that just by looking at which of the sectors were outperforming and just clicking on the little box, and it shows me the stocks that are in that sector. All right. Thanks for watching. Stay safe. Please like and subscribe if you would like for me to continue to do these videos. Let me know what you think. I know I didn't get to any scans today. Let me do one. Here's a weekly scan for the DMI. Micron was in here. So Micron is pulling back, came back to the mean. The mean's right there. But the weekly, so this is a weekly scan, the weekly ADX went above, and it's in a weekly squeeze right now. So this implies that it could fire to the upside, but you can see how far sideways it's going. Really needs to get out above this 120, 115, 120, probably 115 area to break out of this the sideways channel. What else? There's Celsius, made the list. Analog Devices made the list. Right there, they reported on the 19th. So that was 2 days ago. And there's the ADX above 25 right there. That's what we're looking for. ADX going above 25 and the momentum starting to rise. So ADI looks like it's breaking out of this squeeze. It's had a really long weekly squeeze all the way back here into, looks like September of last year. So ADI had a really long weekly squeeze. Looks like they had good earnings and it exploded out of earnings. So that one looked pretty good. Devon Energy, this is another one that was selling off all year. Another one that I said, if you buy it right at the end of the year after all the sell-off, when there's tax loss harvesting through here, probably will take off in the beginning of the year, and it certainly did. So it had a really nice run, pulled back, and then started higher again. So anyway, that's a few to take a look at. On the weekly scan, Fabrinet is another one that appeared. They reported a couple of weeks ago, pulling back today, but right at the mean. The momentum is starting to move higher on the daily, and look at the long squeeze it has on the weekly chart. So it's just starting to move above 25. So this one might just be beginning. It needs to get up here and break out of this weekly channel up here, probably at about 275. But right in there, 279, 280. But if it does that, then it could continue higher if the rest of the market cooperates, of course. And frankly, I don't think it's going to cooperate anytime soon. I think we're going to have some cyclical bearishness the next few weeks for sure, and maybe even longer. I don't think it's going to be a crash. I think I'm still bullish overall in the long run. So I think by the end of the year, probably into the fall, like it usually does, we'll head higher. All right, that's it for now. Thanks for watching. Have a great weekend, and I will talk to you again on Monday. Thanks, everyone.